According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey of supply managers, manufacturing supply managers in the 9 Mid-American states was surprisingly strong, but it was, of course, weak. The overall number dropped below growth neutral, and I was surprised it didn't drop further. Dropped to 46.2 from 52.8 in February. So manufacturing, I have to say, is very weak, but it's much stronger than other sectors of the overall economy. If I can bring up this chart, you'll see the comparison of the Mid-American number in blue against the red number. The red graph there is showing the U.S. number. U.S. number come out later on this morning. I expect it to be well below growth neutral, as our Mid-American number was this month. But again, manufacturing is holding up a bit better than other sectors. For example, retail holding up better than retail, holding up better than tourism, hospitality, which is really being hit hard. So I expect the numbers in manufacturing to get worse in the months and weeks ahead.
What were the hiring trends?
The hiring number was not good. For March hiring, we're at 34. The number for the employment number is 34.7 for March, and that's down from 46.4 in February. February number was already weak, and we saw across the region, first-time claims for unemployment insurance were well up, significantly up. But again, I expect that number to worsen in the months ahead, weeks ahead.
What impact is inflation having?
The inflation gauge was down from last month. The March number is 55.2, and that's down from February's 61.3. So we're seeing less and less inflationary pressures at the manufacturing level, the wholesale level. And of course, a lot of that's coming from oil prices, which are very down significantly from this time last year. We're apt to see that continuing. Not much inflationary pressures out there, and that's reinforcing the Fed's position that they can stimulate the economy, boost economic growth, or boost the economy by very low, record low interest rates. We'll continue to see that. My concern would be for inflation out next year. That's a real concern of mine going forward. But this year, no inflationary pressures, not showing up in our survey, not going to show up in the U.S. survey as well.
What is the impact of coronavirus on the economy thus far?
Coronavirus is having some very significant impacts, but I have to say they're less here in the Mid-America region than we're seeing on either coast. For example, 31.6% of the manufacturers said they had switched vendors. Now that's significant. So moving from one vendor to another, and many of these are international. 55.3% of the supply managers indicated they had moved from international buying to more domestic buying, and they reduced their exposure to international markets. 49, almost 50% said they were rethinking their buying strategies. So that's very significant going forward. 32% said they were moving toward domestic sellers, I should say, rather than depending on international buyers. And more than half, 54.3% of the supply managers, manufacturing supply managers, indicated worker absences. One of the big factors showing up in our survey for the month of March was exports were down significantly. The export numbers down to 34.7 from 58.0 last month. Imports down to 32.7, down from last month's 40.4. So lots of I won't call it isolationism, but I maybe call it nationalism. Across the globe, we're seeing more and more nations cutting back on trade, cutting back on exports, cutting back on imports. So that trend will continue in the future.
What does the Mid-America economy need?
Well, I can certainly say this with a great deal of comfort. We've gotten low interest rates, we've gotten the stimulus package from the federal government's record stimulus package, but what the economy needs, of course, is a vaccine, and that's what we're waiting on. If this goes on much longer, we're in a recession already, and we're going to see a recession in 2020. What we need, of course, is a vaccine to keep this from dipping into what one could call a depression. And if we did see any sort of vaccine, we saw some medical breakthroughs, I could envision a V-shaped recovery, meaning up very sharply. Absent that, this is going to be a tough year, 2020, and without a vaccine, 2021 could be even tough for the regional economy, and for that matter, the U.S. economy. We need to see a global economic recovery. Because of the coronavirus globally, we're seeing cutbacks in the overall economy. That means lower and lower, fewer and fewer sales to our trading partners. We need to see a weak U.S. dollar, which I think we will see with these low, very low, record low interest rates. That weakens the U.S. dollar. That makes it more advantageous for our goods to sell abroad. Also reduces imports, which of course stimulates GDP growth. And finally, we need, in my judgment, we need to eliminate some of the tariffs right now. Even if it's in the short term, the tariffs are restricting trade, restricting some of our manufacturers, restricting their ability to buy abroad. So that's what we're seeing. What we need to see is a reduction of the tariffs.
What are some areas of risk that we need to monitor?
Well, what we need to keep an eye on first is the first-time claims for unemployment insurance, which comes out every Thursday. That'll give a significant indicator of what's going on in this part of the nation, but also the rest of the nation. So that's very important. Also, the yield on the 10-year Treasury. That yield, when it comes down, and it has come down significantly to 0.5%, and when you adjust for inflation, that's negative. That's the level of fear we're seeing in this market. And so when that yield comes down, that's a measure of fear. When it goes back up, that would mean investor fears are declining or moving lower. On April the 3rd, we've got the employment numbers for the U.S. employment numbers. Those are not going to be good, but they'll be much worse next month because, again, the readings were taken well before the real significant impacts of the coronavirus have hit. We also need to keep an eye on other factors such as oil prices. Crude oil prices are down to a level that's not supportive of the shale oil producers. We're going to see more bankruptcies among the shale oil producers. We're in North Dakota, Oklahoma, not good, of course, and those are our survey states. Also, ethanol producers. Number one producer in the U.S. is Iowa, number two is Nebraska, number three is Minnesota. Ethanol producers are not doing well right now because of oil prices, because of fuel prices, because of gasoline prices. We're seeing more and more ethanol closures, more and more ethanol pullbacks. We'll continue to see that until we see oil prices back in the $40 to $50 barrel. In our window right now, we don't see that right now because of significant supplies and also deterioration in demand. So it does not look good for ethanol producers going forward. Again, next month when we produce our numbers, or when we provide our numbers for the month of April on the first business day of May, not going to be good. In fact, I expect them to be much worse than what we're seeing this month. So keep an eye on the purchasing management indices, that's the PMIs, across the globe.